With today's higher interest rates and stubborn home prices, many investors are frustrated that every rental out there right now seems to barely break even or even run negative. Yet if you read the recent headlines from CNBC, according to the numbers, 1/3 of all single-family homes purchased in the second quarter of 2025 was purchased by an investor. This, of course, begs the question, how are they finding cash-flowing deals? Well, my friends, that is a magic question we will seek to answer today. Hi friends, welcome back to the channel. My name is Sylvia and I am your trusty investor realtor in the Boise metro area of Idaho. I have been consistently investing in California, Idaho, and Florida since 2004 and can personally vouch for the roller coaster ride that real estate is as of late. Prices are high, interest rates are high, costs are high, and rents haven't moved much in the last couple of years. And yet, I am here to tell you that there is no reason to throw out the baby with the bathwater, as they say. Yes, you can have cash flow positive property. You just have to use the right tools to build it in. And today, we will look at 4 tools I see being used consistently and successfully in today's challenging market. Before we start, I want to be absolutely transparent with you. First and foremost, I am in the Boise metro area of Idaho, and that is where I know these methods are being used by investors today. That being said, I would bet that Boise isn't the only area where these could work. If you're looking to invest in another area of the US and need an investor-friendly realtor in your neck of the woods, please reach out and we will happily connect you. Second, the methods that we will be going over are not new. They are tried and true with creative twists that have risen to the top in light of our current real estate trends. So with that, let's get into method number 1. Negotiate everything. It is frequently said in real estate that you make your money on the buy. This includes buying the right property, in the right neighborhood, and at the right price. This rule hasn't changed. But just a few years ago, negotiating anything in your favor as the buyer was pretty tough. In today's shifted market, the way to win in the buy is to sharpen those negotiation skills and negotiate every aspect of your purchase. Let's start with the obvious, the price. We are quickly approaching a buyer's market in Boise, Idaho, despite Realtor.com's hotness map where Boise is currently ranked as a hot market. The drastic increase in prices, followed by the even faster ascent of interest rates, has left many sellers dazed and confused when it comes to pricing their home and their expectation on when it will actually sell. They might have purchased their home back when days on market were 2 hours and are panicking when they have had just one showing over the last 2 weeks. Nevertheless, many haven't gotten the memo on how many actual buyers have been forced into the sidelines due to higher interest rates. Subsequently, they start the price high, but after just a few days, they are open to lower priced offers, making them ripe for negotiations. But not all sellers are created equal. Beyond the days on market indicator, focus on those properties that are vacant. Chances are the seller already purchased their next home and might have a mortgage payment coming due. Or if it was an investment property, that renter has moved out and that seller is no longer collecting rent. Both are strong motivators to get that property sold. Don't be afraid to throw your offer out there. If it doesn't stick and it's still worth the buy, move on to the next negotiation point. A lower price is a great starting point, but it isn't the end-all be-all. If the seller is set on their price, move on to concessions. Redfin recently reported that 44% of all sales in the first quarter of 2025 included concessions offered by sellers. Friends, that's almost half of all transactions. And even better, the concentration of those concessions were being offered in the Pacific Northwest. Hello, Idaho. Concessions can take the form of a seller credit to pay for closing costs, needed repairs, or as of late, bringing down the buyer's interest rate. As more sellers recognize the crippling effect of high interest rates on a monthly payment, sellers are signing up to offer money specifically earmarked for buying down the rate. And actually, here in Idaho, the king of seller concessions right now are builders. Rarely will they lower the price, but throwing in some money for you to buy down your interest rate is strong in their incentive packages. It is not unheard of for local builders like CBH, Lennar, and Hubble Homes to kick in enough money to bring down that rate significantly. Once you're under contract, don't let your home inspection contingency go by without the opportunity to negotiate repairs. Most investors assume that if they negotiate a lower price, they have to take the home as is. But here's the deal. Your initial offer is based on what you see, but not all damage to a property can be readily seen when you walk through. Attics and crawl spaces are teeming with problems in some homes, and a good inspection can uncover a repair that could run you thousands to fix. If the problem was not disclosed and comes as a surprise to the seller, then make sure you negotiate some money if it won't be fixed. In the state of Idaho, and I suspect many other states as well, once a material defect is uncovered, a seller will have to disclose it to any future buyer, most likely eliciting a lower priced offer from that buyer. Save them the trouble of going back on the market and ask for the repair or a further reduction in price. Negotiation doesn't stop with the transaction. You can continue your negotiations after you close with your tenant. In our Boise area, it is not uncommon to find rents on listed properties way below market rates. Simply bringing up those rents upon renewal can be a great strategy to cash flow a property. Others may take some creative upgrades to bring some value to your tenants in exchange for a higher rent. Things like adding laundry facilities to a property. Even if it was coin operated, more potential income for you, it could be worth it to a tenant to run downstairs and throw in a load as they are cooking dinner versus taking a Saturday to do 3 to 4 loads 10 minutes away. Or what if you were able to frame in some covered parking and storage on the side of a property? Covered parking in our area will easily bring you an additional $50 to $75 per month. And what about adding extra space inside the property? In our area, many properties have a bonus room or office space. What would it cost to put up a strategic wall and convert that 2-bedroom into 3? Or a 3-bedroom home into 4? In these parts, the rent difference between a 3 and 4-bedroom is easily $200 to $300 per month in additional rent. And while you're thinking about adding dividers, what about adding extra space outside for Fido the dog? Putting up a fence will help you not only charge more money for pets, but will also help you reach a much higher percentage of renters. I see this as a missed opportunity quite often in multifamily where most units share 1 yard. Put up that fence. Many tenants will gladly pay the extra for privacy. This next tip is not for everyone, but for those who are able and willing to house hack, I have an amazing trick to increase the cash flow on your next home. I did a video recently where I went over how buying a duplex instead of a single family home would cut your monthly out-of-pocket expense by nearly half. I will link it below. But what about that single family home? Well, there is a new way to supercharge your house hack that is quickly becoming more popular in our area. Have you heard about assumable loans? In a nutshell, assumable loans are government-backed loans offered by FHA or VA in which a qualifying buyer can assume the loan balance, including the interest rate, without changing any of the other loan terms. Why are they so lucrative? Assuming a lower interest rate translates into a lower monthly payment. A $400,000 loan with a 6.5% interest rate, which is where rates are currently hovering for owner-occupied properties, is roughly $2,530 principal and interest. That same $400,000 loan that you could assume with a 3.5% interest rate would just be $1,800, a savings of over $730 per month. That is $730 that you can save just by assuming someone's low rate. So what's the catch, you may say? Well, there are 3 caveats to this method. 1, you must qualify under FHA or VA guidelines. 2, you must have the difference between what is owed and the purchase price in cash readily available. And 3, you must occupy the house, hence house hacking. Let me zero in on caveat number 2, as that might be the hardest one to overcome as a house hacker. It's no secret that Boise had an unbelievable appreciation run right around the time that interest rates were at their lowest. So trying this method on a home purchased back in 2020 is going to be hard to hack simply because the average priced home in 2020 was $345,000, while today it sits just shy of $550,000. But what if you could find those sellers who bought in early 2022 when the average price was $527,000? Bridging that gap might be still difficult for a first-time home buyer, but for an investor prepared with 20 to 25% to put down, the opportunity to scoop these deals up just got magnified. Why take that 20 to 25% down payment and apply it to an investment property and suffer the higher investor rate, higher loan costs, higher insurance, and in Idaho, higher property taxes when you can assume a loan, move into the property for a year, and drastically reduce your monthly outflow, allowing you to save more money for your next investment purchase? Friends, if you're in a position to take advantage of this new way to house hack, do it. Okay, onward. Let me tell you about the third option, seller financing, and why it is one that is primed to explode in Idaho. According to Fortune, about 40% of current homeowners in the U.S. have no debt on their home, an important criteria for seller financing. And many of them are finding themselves up against what the media is calling the hidden home equity tax. With our recent mass appreciation in home values, combined with homeowners staying in their homes longer due to the locked-in effect of lower interest rates, a significant number of would-be sellers are quickly exceeding the maximum capital gains exclusion they can take when they sell their home. In fact, the National Association of Realtors found 34%, 29 million, of current homeowners already exceed the $250,000 exclusion for single filers, and about 10%, or 8 million, already exceed the $500,000 exclusion available for married couples. That means close to 40 million homeowners nationwide are up against extra taxes they weren't expecting should they sell their home in the traditional way. And in Idaho, 55% of homeowners already exceed that threshold. What is even more interesting is many of these sellers are actually baby boomers who are choosing to rent instead of buying a new home. According to a recent Newsweek article, in the past 10 years, the number of seniors entering the rental market has surged by nearly 30%. Are you seeing the picture I'm painting? Baby boomers who own their home free and clear are choosing to rent instead of buy, will be looking for ways to avoid paying those capital gains. What if you could offer that in a way that also translates to you securing a note at a potentially lower rate than what a bank would offer? Could that be a win-win situation? Another similar situation can be found by targeting those old-timer landlords who are ready to retire. They don't want the hassle of managing tenants anymore, but would still love to have that steady monthly income. And if they are not doing a 1031 exchange, then seller financing can help them minimize the tax they will pay in capital gains by spreading that over many years. Friends, both of these situations can be gold for you as an investor. If a seller does not plan to use that money to reinvest it in another property, chances are they are putting it in the bank. A high yield account might get them 3% and a CD might fetch them 4%. What if you were willing to give them 5%? When current investor rates are upwards of 7%, 5% would go a long way to bringing down your monthly payment, while still bringing a win to the seller looking to keep their tax liability low. And unlike the bank, a private seller might be okay with a lower down payment, further stretching your capital for repairs or renovations. These sellers are already in our market and probably don't know about this option. Don't let your realtor bypass the opportunity to present this as a viable solution to their problem. My final tried and true method is one that I personally subscribe to, especially for my properties that have higher interest rates. And that is recasting the loan. Many lenders will allow you to send in a lump sum to your principal and charge a nominal fee to recalculate your payment based on the new principal balance. The interest rate stays the same, the term doesn't change. At a 7.5% interest rate, a $20,000 down paydown with a recast translates to $140 per month difference in your payment. And just like that, you have more cash flow. Now, I understand that not everyone can do this. However, as rates stay high and chances of refinancing are not only costly but slim, this could be a better way to pull some monthly income from your property. A tax refund or lump sum bonus would go further in a recast than just sending it into the principal or keeping it liquid until you have your next property to buy. And if you are like some investors, you might have other rental properties that are cash flowing better. Instead of refinancing that property, which forces your monthly payment to go up, why not redirect some of that cash flow to recast this loan and have them all bringing in extra money a month? Anything that widens the gap between your monthly payment and what you get in rent is a win in my book. Friends, I hope you gleaned some value from this video. Real estate wealth isn't built overnight. It's built strategically with planning and, in our current market, lots of creativity. And while cash flow has become harder to find, I hope you take some of these methods as a way to force that cash flow into existence, or better yet, force it to grow. If you want to learn more about running the numbers on your next property or want help identifying opportunities that can actually cash flow in this market, reach out to our team. We are always here to help. Thanks for watching and catch you on the next one.